In the year 1720, Britain's most influential people, the scholars, the aristocrats, the policymakers, walked willingly into a financial illusion so convincing that it swallowed fortunes in a matter of months. The catastrophe didn't spare anyone. Politicians, wealthy traders, or even the most brilliant scientist of all time. Isaac Newton, the man who decoded gravity and mapped the stars, believed he was on the brink of limitless prosperity. Instead, he became one of the earliest victims of one of history's most spectacular financial implosions. The South Sea Bubble. And here is what is truly disturbing. The exact mechanisms that trapped the smartest minds of the 18th century remain alive in today's financial world. The same psychological triggers, the same manufactured hype, the same engineered illusions. The South Sea Bubble isn't just a chapter in a history book. It is the operating manual for how financial manias are built, sold, and detonated. To understand how this disaster became possible, we have to return to Britain in the early 1700s. The country had just emerged from the War of Spanish Succession, a massive, expensive conflict that drained the treasury dry. The government was buried under tens of millions of pounds in debt, a crushing burden for the time. Servicing the interest alone consumed huge portions of tax revenue, and creditors started to doubt whether the crown could ever repay what it owed. Into this environment stepped the South Sea Company, created in 1711. On paper, it looked extraordinary. The company was granted an exclusive trade monopoly with South America. London investors imagined treasure ships returning with mountains of silver, gold, sugar, and exotic goods. But none of that was real. Spain controlled nearly all of South America, and Britain's actual trading rights were barely more than symbolic. The company's true business model had nothing to do with ships or goods. It was about transforming government IOUs into tradable shares. The South Sea Company proposed a simple arrangement. It would absorb a massive portion of Britain's national debt. In return, the government granted it guaranteed payments, and creditors received company stock instead of government bonds. The pitch was seductive. Debt holders could swap into a speculative stock that might multiply in value. The government eased its immediate burden. The company gained political clout and public legitimacy. Everyone thought they were getting a shortcut to wealth. But beneath the glossy surface was an uncomfortable truth. The promised riches from South American trade were a fantasy. The entire structure depended on selling the illusion of future profits, not on real economic activity. Yet the illusion spread like wildfire. By 1720, the South Sea Company unleashed an enormous marketing campaign. It flooded London with promises of unprecedented prosperity. Directors bribed parliamentarians. Newspapers published glowing predictions. Rumors circulated about secret deals and untapped wealth. Shares skyrocketed from around £100 to nearly £1,000 in a matter of months. And the frenzy consumed everyone. Shopkeepers, nobles, merchants, even members of the clergy rushed in. The bubble didn't discriminate between ordinary citizens and the elite. Isaac Newton himself invested early, made a tidy profit, sold his shares, and then, like millions today, he watched the price spiral upward and couldn't bear to be left out. He bored back in at the top. When the bubble burst, Newton lost the equivalent of millions of pounds. He later confessed, "I can calculate the motions of the heavenly bodies, but not the madness of men." That single line has become the most famous summary of speculative mania ever written. The mechanics behind the bubble were painfully simple. Rising prices attracted more buyers. More buyers pushed prices even higher. Parliament, many of whose members had been bribed, cheered the rise instead of questioning it. Even King George. I accepted a ceremonial role in the company, giving the scheme the shine of royal approval. People sold homes, borrowed heavily, and liquidated family estates just to buy shares. It was the 18th century's version of a crypto boom or meme stock frenzy. Nobody wanted to be the only one not making easy money. But the truth never changed. The company had almost no real profits. Dividends were funded by money from new investors, not from actual trade. It was a pyramid, disguised as a monarchy-endorsed enterprise. Eventually, doubts surfaced. A few investors tried to take profits, prices deep. Panic spread, and within months, shares collapsed back toward their original value, obliterating a staggering amount of wealth. The fallout was devastating. Ordinary people lost everything. Shopkeepers and small traders were ruined. Middle-class families saw their life savings disintegrate. The wealthy and politically connected, however, were largely shielded. Many were secretly compensated to prevent political instability. Once again, as in every bubble before and since, losses flowed downward while the powerful walked away bruised but intact. The scandal rocked Britain. A parliamentary inquiry exposed a web of corruption. Government ministers, MPs, and even the Chancellor of the Exchequer had accepted insider shares, bribes, or preferential terms. A few South Sea directors were prosecuted and stripped of assets, but the deeper system, the alliance between political power and financial speculation, survived untouched. The Bubble Act of 1720 was passed during the mania under the guise of protecting the public from fraudulent enterprises. But the truth was more sinister. The South Sea Company had lobbied for the act itself to eliminate its competitors. It was regulation designed not for the public, but for the architects of the bubble. That irony has echoed through every financial crisis since. The broader consequences were enormous. Trust in corporations evaporated. Investments slowed for decades. The Bank of England quietly rose in importance as the government's reliable financier. And the national debt, the very problem the South Sea Scheme was supposed to fix, remained, simply shifted onto the backs of those who had believed the illusion. Why does this matter today? Because the South Sea bubble is not an anomaly. It is the blueprint. Look at the dotcom bubble. Companies with no profits and no real business model traded at insane valuations. Look at the housing collapse of 2008. Toxic mortgages packaged as safe assets, sold with official approval. Look at modern manias meme stocks, speculative crypto hype-driven assets. Enormous promises, thin fundamentals, and insiders cashing out, while the public pores in the story has never changed. Only the technology changes. The psychology does not. The South Sea bubble teaches a brutal truth. Intelligence alone cannot protect you. Newton's failure is the ultimate warning. Financial manias are not built on logic. They are built on narratives powerful enough to override logic. So what is the lesson for us? Learn how bubbles form. Question promises of guaranteed wealth. Understand value instead of chasing hype. And, above all, remember, whenever you hear that this time is different, history guarantees it isn't. If this helped you see finance more clearly, hit subscribe. History exposes the patterns, and this channel helps you spot them before they catch you.